Hello. What you're looking at is the TexasVestments.com About Us page. We are an investment club based here in Dallas, Texas. I'm the club president, Lee Ennis. We have our list of stocks, and so we're going to do a surface level comparison between what we currently have and what our new portfolio is calling for. First up, basic materials. Right away, we see that WY Weyerhaeuser, much larger dividend than CF. CF is an agricultural company. They simply sell fertilizer. That's basically all they do. Looks like CF is cheaper, just based on the PE. We see that all these numbers are the same. What that simply means is that we do not have current information in the system for these companies as far as the 5-year high PE or the 5-year low PE. And so what we do have is simply a difference in the average for the sector. And so we see here that Weyerhaeuser is above average and CF is below average. So again, it looks like CF is the cheaper stock at this point. Net profit, CF blows them out of the water. That's really great. And I think that's really important based on the fact that they have roughly similar operating margins. So what this simply means is that after the initial cost of making money, right, it appears that Weyerhaeuser has way more administrative costs, and I can believe that Weyerhaeuser has a fairly large pension that they've been trying to roll down, but doesn't do so well for their bottom line. Return on assets looks like CF does a bit better than Weyerhaeuser. Let's pull this decimal out, and there we go. So again, Weyerhaeuser probably has way more assets, but it looks like CF is actually getting a bigger profit with the assets that they have. CF, way more cash than what Weyerhaeuser has in the bank, and that's a good thing. We want that cash to be high because a portion of that cash is ours when we own that stock. So we'll be looking at this is the cash per share. So roughly $4 of the share price is actual cash. So that's a really good thing. Cash to debt ratio. Again, this just talks about basically how much cash is in the bank. There's not a whole lot to say about that just because there's such a huge difference in the amount of cash there. Percent short, so roughly, same amount of people is betting on this stock to lose. Let's pull this decimal out, see if we have the same number. So no. So we actually know that this is a good number, and it's about the same. So looks like both these companies are about in the same place as far as the price goes. They are roughly 10% away from their 1-year highs and about 30% above their 1-year lows. So they're in the same place. Now on to the scores. Looks like their alpha score is about the same. That's to be expected. Of course, CF's up move is almost double Weyerhaeuser's, and that's kind of what we're looking for. Down move is the same. Weyerhaeuser's beta is much better, which I can understand because it has such a large dividend. It's a safe play. So when the market is not doing so well, people tend to invest in companies with larger dividends to help safeguard their investments. This is something I did not expect. Looks like Weyerhaeuser's average monthly return is better than CF. So that gives me a little bit of pause. CF, a bit more volatile. It's up and down a bit more. As far as The score, of course, much higher for CF because of that portfolio change. And surprisingly enough, the management score much higher for CF, and a lot of that has to do with the cash available in CF's bank. So we'll look at that a bit closer. We'll dig into the financials and really see what's going on there. Okay, so for communication services, we have British Columbia and Rogers Communications. Both of these are Canadian telecommunications company. BCE's dividend much larger than Rogers, which is a good thing. Looks like the PE is about the same. Rogers is a bit cheaper, which makes a lot of sense here. It looks like Rogers is nowhere near their 5-year high, and BCE is close. The average PE for BCE is 18 and 27 for Rogers. So it looks like Rogers is much lower than average, and it looks like BCE is about where it's supposed to be. So what this tells us is that Rogers Communications is very cheap right now compared to what it's been in the past. Both the net profit is the same. Again, very similar companies doing exactly the same thing. Rogers Communications has a bit more in the way of assets and different ways to make money than BCE. We don't have anything on operating profit. Return on assets, again, about the same. Same amount of cash. Let's pull out these decimals and see if we're looking at the same numbers here. So this may be, yeah, so this is going to be a sector average. So we don't actually have the cash on this, so we just have an average there. Let's see, cash to debt, that's going to be the same. Looks like Rogers has a bit more persons looking to make money on Rogers Communication doing bad than BCE does. Looks like both of these companies are really close to their 1-year highs. Rogers is a bit off. Rogers is closer to his 1-year low, however, but BCE is off the lows quite a bit. Rogers Alpha is a little better. Of course, BCE's up move much larger. Rogers down move is better. It's lower. And see, beta is the same. Looks like Rogers 1 month return is a bit better. Volatility is the same. Of course, the score is going to be better for BCE because of the portfolio change, and the management score is about the same. So these companies look very similar to each other, with the one big difference being the dividend of BCE and the what appears to be relatively cheap valuation for Rogers. So we'll dive into this a little deeper, get into the financials, and really find out what Rogers' valuation is and whether or not the dividend for BCE is sustainable. Consumer cyclical sector. We're currently in Hasbro, which, as you can see here, from purchase to current price, has done really well. There's a few other standouts here. It looks like DRI has done okay. I'm going to pull out these decimals just a little bit, just because they're so similar here. And yeah, I mean, that didn't change a whole lot. So the dividend is about the same. Looks like GPC is a bit higher than the rest, but Hasbro's it's lower just because the price has increased so much in the recent months. All right, so looking at the PE, it looks like Best Buy, of course, is the cheapest. GPC is next, and Hasbro is really high So that gives us a little pause. We'll look into seeing exactly why that is once we get into the financials. Um, you have a difference in PE here. Looks like everything in the sector is below their averages except for Hasbro. So it may mean that it's time to get out and look for another option here. Net profit looks like DRI is about the same as Hasbro. Doing about the same things here. Yeah, it looks like DRI comes out a little better as far as net profit goes, but they're really all about the same. Hasbro and DRI is anyway. All right, return on assets looks like DRI much better than the rest of the field, with Best Buy in a very close second. Cash per share looks like Hasbro just blows them out of the water here, and Best Buy is in a second place there. Now, the debt, I'm going to have to assume that the cash debt ratio is much higher just because there's so much cash on the books. Again, we'll dive into the financials just to make sure that is the case. Looks like both Hasbro and DRI have some naysayers. There's some betting on falling prices. Everyone looks to be about the same place as far as their prices go. Everyone is, just under their 1 year high. DRI and Hasbro are a little closer than the rest. Again, Hasbro, Best Buy, way off their lows. DRI and DRI and what is it? GPC. Yeah, they are very close to their lows. As far as the scores go, Alpha, same for everyone here. The up move is much higher for DRI, so that's good news. Hasbro, it's not far away at all. As far as down moves go, looks like Best Buy best in the sector, and Hasbro's way down there. The beta about the same for everyone. Looks like Best Buy has a better monthly average return, even though it has lost money recently. Volatility very high. All right, and let's look at the scores. So, of course, we have GPC, which scores much better than the rest of the sector, and Hasbro, because of all that cash, has a better management score. So I'm going to dive a bit deeper into the financials to really see, the best way to go here. Honestly, I haven't seen anything, really convincing other than the fact that Hasbro has such a large PE. What I would be interested in is to find out for sure exactly how much cash is on the books, if it's cash, what kind of cash it is, what they plan on doing with it, right? I'd also want to take a look at the debt and really see what the valuation is for GPC and Best Buy as well. Best Buy has been a story, right? I mean, it's been around forever. Everyone knows it, but they have struggled. And so we'll dive into those companies and see what's best for us to do. Get out of Hasbro, get into something else, or just hold on to our Hasbro. The consumer defensive sector, we're currently in Target. Altria has not performed well at all. A lot of that is due to the fact that smoking is banned in many places. I think there's a real public policy push to stop smoking. They've gotten into vaping, and even the vaping thing has come under fire lately. There's a lot of health problems there and issues. And so, of course, that's the reason why the dividend is so large, because the price has come down so much. But let's take a look at the rest of this. GIS has performed fairly well. Their dividend is, almost double Target, so that's a great thing. BTI, again, has not performed well at all, thus the large dividend. All right, PE-wise, looks like I need to pull this out. BTI is the cheaper company here, followed by Altria, of course, right? It looks like GIS and Target are about the same. GIS is a bit more expensive, and with the price action of Target recently running up as high as it has, I'm surprised the PE ratio is still as low as it is. So let's take a look at our averages here. Looks like everyone is under their average, with Target being much lower actually, and Altria being even lower than that. So that's good. So it looks like everyone is, about the same here. All right, so net profit. Now, these are all different businesses, so we can't look too much into this, but it is important to note that both Altria and, I keep forgetting this company up here, and BTI, British Tobacco, have roughly the same net profit margin, which is to be expected. GIS and Target, again, can't really compare those, but definitely BTI and Altria, we can compare those. Operating profit margin, again, can't really compare those. Return on assets, they're all positive. Again, can't really compare those. We're looking at two totally different businesses. It is important to note, though, that the return on assets for Altria seems to be much higher than the return on assets of British Tobacco. So I think that says something about the management of the company. All right, cash per share. Target, lots and lots of cash on hand. That has a lot to do with the business itself. Honestly, they deal with a lot of cash. They're basically a Walmart, so millions of dollars are running through their hands, minutes, hours a day. So we want to dive in and really see what this cash is and what they're doing with it. I can imagine that a lot of it is just, kind of on hand, and that won't change very much. Cash debt ratio, this is a bit shocking, honestly, because of there's being so much cash. I expect the cash debt ratio to be much higher, just like we've seen with some of the other sectors. But this must mean that Target has a lot of debt compared to these other guys. And again, Target has real estate, so very capital intensive. It makes sense that they would have more debt. Looks like Target has many more naysayers, and I can imagine, they are going up against Amazon and Walmart, right? Their prices are about the same. The only difference here is Altria is way down right now, and again, that's a lot to do with the news cycle. Same thing with British Tobacco, BTI. GIS is way off their lows. Same for Target. Alphas, all about the same. Up move, much higher. for BTI, but comparatively, I don't think the rest of the group is far behind. Um, I have to take a look at that a bit further and see just what 11 points means, right? For the down moves, looks like GIS much better off than the rest of these guys. Target, um, not great at all. We did see a lot of down indicators when we were looking at our portfolios, but not so much that it would give me pause for having this high score for down. All right, beta, I would say about the same for the group. Target comes out a bit better. The 1 month return again looks about the same. Altria is the only positive in the group. Volatility, same, no change there. Here we have GIS, which has the better score, and I mean not even close. BTI is close, Altria is almost there, but Target is way down on the list, and so that's something that we'll really have to take a look at. I mean, if we're going to change out this portfolio and follow and what has been working, then we may really want to see about cycling out of this and maybe getting into GIS. Management score, again, because of all the cash on hand, Target blows everyone else out of the water. Let me take another look because, again, there's not a lot here other than the cash on hand and the net profit, the cash on hand. There is a difference in the PE for sure. So I want to dig into these just a little bit more and just really see what the valuation is for these companies. I really want to check out the cash, and this dividend looks really good. So services sector, currently in BX, Blackstone, and it's going to be really difficult for us to move out of this. Blackstone has been, a very a good performer in the current economic climate. We have falling interest rates, and banks don't do very well when interest rates fall, and so that's the reason you see the price performance of these other two companies here has just not been very good. Dividends are about the same, so that's good there. Looks like Blackstone, of course, is way more expensive than these other guys, and all of that has to do with the fact that the price has run up almost 50% in the last 18 months. Valuation is something we'll need to look at, of course. We have a sell signal on Blackstone right now. If it's too expensive, maybe it's a good idea to sell now and put in a short option to buy it later. That is an option for us. Looking at the difference in PE, looks like Blackstone is way above its average PE, and the rest of these guys are under their average PEs at the same rate. Now, this is interesting. We have a net profit on, what is this, PRU? I think that's Prudential Insurance Company. And their net profit is 44%. Now, with Prudential, what they're doing is they're simply taking in money from customers, right? And then they're investing that money in the market, and they're investing it in other assets. And again, when interest rates are cut, then their returns are cut. Okay, and so that's the reason why we haven't seen very good performance out of this company. recently. But 44% net profit, that's huge. Most of their business, as far as managing the bottom line, is going to be not paying out claims, right? A lot of that has to do with only bringing in customers that won't, how do I say this, that won't get paid out, right? And then managing the customers that do have to be paid out. And the better you do that, the better your bottom line. At the same time, we see Blackstone here with the operating profit, right, 44%. And so, same thing, okay, same thing. Two different businesses, but as you can see here, the numbers are literally the same here. And so we see the same thing with Key, 38% operating profit margin. So that's really good. Return on assets, about the same. Again, these are different companies, but not a lot of capital and assets needed for this type of work. Looks like there's a whole bunch of cash on hand for Prudential, and I would want to know what this cash is, because cash means a bunch of different stuff. Cash can mean CDs. Cash can mean marketable securities, which means stocks that are being held for sale, right? That's as good as cash. And so it's very possible that that's what this is here. With that being said, there must be a huge amount of debt on the books for the cash to debt ratio to only be, a bit above what we see here, for these guys. Blackstone 2.3, Key 2.6. So that's the same there. There's going to be a larger short interest on Blackstone, primarily because the price has gone up so high, right? People are betting on it to fall soon. With that being said, all these guys are about the same place as far as their prices. Blackstone, of course, is a bit higher than the rest. And same goes for their lows. Lows are about the same. Blackstone's just price is astronomical right now. Up move, much better for Key. It's kind of what we're looking at. Down move, much better for Blackstone. See betas, about the same. Monthly average return is actually better for Key and Prudential. And I want to mention that this monthly return is actually August 2015 through June of 2018. Okay, so we're not talking about a monthly return anywhere past June of 2018. So this is the last, roughly 3 years that we're looking at. And so over the last 3 years, we've had interest rate hikes, and so banks are performing very well, and that's the reason why you'll see a difference in average return there. Blackstone, a little more volatility. This is really good to see, actually. As far as the scores go, Key, scores the best, but Blackstone is really not far behind. It's very close, very close. Same thing with their management score. Prudential, much more cash on hand. That's why the M score is so high. But what I'm concerned about, and what I will have to look into, is the valuation for Blackstone. The valuation. They're always doing deals. They just bought out a company, cash, just recently. And so what we are concerned about is this PE ratio. We're concerned that the price has gotten too high for the real value of the company. Okay? And what can happen if it gets too high, people start saying, hey, you know what, this stock is way too expensive, we're not buying it anymore. And if persons aren't buying it, then they're selling it. Okay? And if they're not selling it, then the price is doing nothing, right? and then all you're doing is just collecting a dividend. So we want to really take a look at the valuation on Blackstone and make sure we know really what we're getting into. It looks like Key is second best. It's relatively cheap. It has decent, profit margins. Has cash on the books. Cash debt ratio is not, great, but not too crazy. It's what the system calls for right now. So we'll do a dive in on these two companies and